We are in the middle of the $1 trillion wealth addition to Australia that is happening right now.
But it is everywhere. So it's spread across the country. Some areas are doing better than others, as is always the case.
If I'm buying right now, I'm probably looking at an asset like that. I'm probably targeting the Melbourne apartment market because it's the same story.
Interest rates are really, really high. It's hard for feasibilities to stack up.
We are in that situation right now. We are not with the rest of the pack right now.
No, if you're not going to put it into something else that's useful, then I'd say you're better off holding.
What am I going to do in this circumstance? The everything everywhere property boom is happening all across Australia. It is broad-based. In the last quarter, every single capital city posted positive numbers. Some of the numbers are very, very large too, with multiple markets running at double-digit paces. In this episode, we're going to go through what the final quarter of the year looks like and go through capital by capital, state by state, unpack exactly what is going on and what moves you should make going forward. Curtis, how are you, man?
Pretty good. We like booms. So
like
good
it?
for morale.
I felt energy just saying that out loud. It was just like, that's the feeling you get when you hear the word boom.
Yeah, especially when there's some actual data to back it up. It's not just like, I feel a boom.
Yeah.
It's like there might actually be one.
For sure. Let's get rolling straight away here. Let me unpack for everyone what's actually happening in the market. We've got the September data out now. So it's been 9 months of the year. How are we actually performing? I'm pretty sure it is rocking, because I know in lending world, it is absolutely flying. And that just means property world is going to be flying very soon. We're in the very soon right now. Give it to the audience.
Yeah, exactly. So if we just look nationally, or the headline stats, so fastest monthly gain since 2023, upward that is. National value's up 0.8
in a month.
In a month, yeah. So and that's the highest, the highest that's number been since any time since 2023.
Yep.
Can
I put context to that? So
yeah.
0.8. Everyone, 0.8 multiplied by 12. Do your quick math. I'm doing a lot of math with my 3-year-old at home. That equals 9.6%. Is that right?
Yep.
That's right. So that's roughly 10%, double-digit national property price growth happening right now. That's the momentum that you're seeing. That is rapid. We have an $11 trillion market. If it goes up 10% in a single year, that's an additional $1.1 trillion. We are in the middle of the $1 trillion wealth addition to Australia that is happening right now. Australians are going to be the wealthiest they have ever been within 6 to 12 months. We are going to make a lot of money per person across the board. It is a pretty monumental level of change. Putting it into context, if you added up every single mortgage in Australia, every single one of them, jumped it all up, about half of them would have gone just from this price growth that's going to happen. That's how large the value change is that we're experiencing right now. National data is big, and when you're rising nearly 1% in a single month, it shows you exactly what's happening, especially when it's every single market.
Yeah, that's the thing that's interesting. And I know we've spoken about this on previous pods about it being kind of like an everywhere situation, but yeah, the data kind of backs that up as well. So to give you some of the quarterly numbers that we can break down by different cities that I've got here, we've got like the national number 2.2%, but Sydney's up 2.1, Melbourne's up 1, so Melbourne's no longer flatlining, Brisbane up 3.5, Perth up 4, Adelaide up 2.5, Darwin up 5.9, basically 6. But it is everywhere. So it's spread across the country. Some areas are doing better than others, as is always the case.
Yep.
But it's not a scenario like we had maybe a year ago where you've got some markets falling or showing negative data when Melbourne was still negative. Other areas a bit flat like Sydney and, Perth and Brisbane going gang and Adelaide going gangbusters. It's much more broad-based now.
Yep, for sure. Adding in Canberra, 1.7%, it's just started flying as well. And Hobart isn't moving at all at 0.1%. It's the laggard behind everyone else, but everywhere else, combining it, it's rising really, really sharply. Capitals are outperforming regionals as well. Capitals at 2.3%, regionals at 1.8%. And within this data, we're actually going to unpack Brisbane and Perth in this episode very specifically, because there's been a obvious re-acceleration in dwelling price growth in these capitals. And it is that shift we've been talking about for a period of time. It is units dominating the scene in some other capitals now, a reversal of that trend that you've been seeing for the last 3-4 years. The unit story in Brisbane and Perth is extra strong right now. And we're about to unpack that next as well. So pretty crazy numbers, broad-based growth. Things are doing really, really well. Can we go through supply levels?
Yeah, so these are some of
into
the interesting stats, because basically listings are at record lows. And that is, I think, one of the big driving factors behind this broad-based price increases, basically. There's an immigration story of more people coming into Australia. Demand is kind of there. But if no one's selling houses or people are listing houses at record lows, that deflates supply and provides upward movement in prices regardless, basically, of what else is happening. So we're seeing Darwin, 53% below what it normally is in terms of listings. Perth, 45% below what it normally is in terms of listings. Brisbane, 31% below its average for listings. So it's as much a low supply, low listing story as it is all of a sudden everyone's cashed up, or there's a whole bunch of new buyers out there, and the demand side of it is the main driver. I think there's a bit of that too, but it's a combination of the two factors.
I actually think this listing number is actually a demand story. I know it's coming out in the supply metrics, it's coming out in the supply numbers, but the reason why Darwin has no supply right now is because it's all been taken up. There's so many buyers out there being like, I want one, I want one, I want one. And you do that for 6 months, there's nothing left.
Yeah.
So when you're measuring total listings, Darwin just doesn't have listings. It's down 50% on its normal level. It's extraordinarily low, and you're only left with the stuff that nobody wants to buy, the really, really crappy stuff. And the investors will be picking that up now because they can't pick up anything else. They're like, I want a piece.
It's all that's left, yeah.
It's all that's left. That is the demand story that's coming out right now, especially when you have such a... It's just changed dramatically. It's what supply listing levels in Darwin have typically been here for 10, 15 years, and then 6 months later, it's boom, down here.
Yeah.
The reason for that is because, it's the investors driving that market, and owner-occupiers too. The really interesting one here is actually Perth, the Perth story. Let's go into putting the spotlight on Brisbane and Perth specifically, because there's so much interesting data here. Perth stopped growing for a year. It stopped. It just went from 15%, 20% to zero for nearly 12 months. We've been saying for an extended period of time that the momentum of Perth is very, very strong. It's also got a 4.2% rental yield. So it's still the one that you look at being like, no, there's plenty of room to run there. And we've been saying that, hey, it should have double-digit growth, but it really didn't hit that over the last 4 months. It paused. It just hit pause. Now that re-acceleration is there, back to that equilibrium level, and prices are running really, really hot at the moment, 4% in a quarter after coming off from a near zero base as well. So it's just taken off, really. That's the best way to describe it, on the back of no listings at all on the marketplace and demand being very, very strong all across the country. And Perth numbers still look pretty good for a property investor.
And still population increases, or net migration to Perth being pretty strong as well. But I think that was one that like you say, the yields suggested that there was maybe still a little bit more room to move. But whenever somewhere takes a little bit of a pause at that point in the cycle, it's always a little bit tricky to work out. Is it going to re-accelerate or is it going to peter out?
Yeah, for sure. We've done a few episodes, especially around the Trump trade war earlier, where it was hey, bit of a question mark when it comes to Perth and Brisbane, not Brisbane so much, but Queensland, around what impact will it have on our core supply markets. And I guess this is still a bit of a question mark. I'm pretty sure last night iron ore got completely blocked from China to Australia as part of some negotiation strategy. So these factors are potential consequences, but it really has not materialized in any negative way, in only positive ways, because the unemployment rate in Perth is 3.5% as well. Very, very strong. Employment growth is very, very strong. It's got the reacceleration on the ground of its economic activity, and you're seeing that pick up in pace in the housing market at a time where there's not enough listings, even though the construction cycle is starting to increase up again. So that Perth, I would just say there's about a 15 to 20% equilibrium price difference between where it should be and where it is. And when I make that number up, I'm kind of spitballing a little bit. I'm just comparing to Brisbane and Adelaide.
Yeah.
And Brisbane and Adelaide have stretched to the affordability limits.
Yep.
Perth has not stretched to the affordability limits yet, and it's the cap on where this could go. Perth has more room to run. If Brisbane, Adelaide sitting at 3.6, Perth at 4.2, and you have really strong economic fundamentals, you've had history, you've got previous history of it being the least affordable capital, it's got more room to run to come down on rental yields alone, plus it's got the highest incomes in Australia and the lowest unemployment. So you put all that together and no listings, you put that all together, you're like, hey, prices should be 15-20% higher than where they actually are. The price level isn't right. A bit like Darwin, the price level is just wrong. Perth has that scope there. Long term, I'm not too sure, but definitely over the next 12 months, there's a clear prices are just not at that equilibrium level yet. And it makes sense for it to catch up to Adelaide and Perth, Brisbane a little bit more.
Yeah, for sure. So do you want to unpack Brisbane a little bit? Because that's one that I find particularly interesting. Like you kind of flagged, the unit numbers there being so strong. And I know, again, on some previous pods, we've talking about there being some potential almost arbitrage there with construction where you're basically buying things at, construction cost essentially. But yeah, do you want to unpack that a little bit?
Yeah, Brisbane units up, outperforming houses 7 quarters in a row, and Brisbane house prices have been rising pretty strongly for a period of time. So apartments are just catching up a little bit. So there's that component. Houses have risen more than apartments over time, so apartments are catching up. This is one where we probably deviate a little bit, where it's like never buy apartments. I just don't believe that. I think that's just wrong. Never buy apartments. That's the wrong advice to get. It's a little bit too simplistic. You got to look for the opportunity, and apartments they're so easy to actually understand, especially when you've been in a chair like ours for 10, 15 years. You can start seeing cycles play out, and the apartment cycle is easier to unpack. Demand is a bit clearer because who is buying apartments? It's typically easier to understand that demand framework over periods of time. But more importantly, supply is so easy to measure.
Yes.
Your apartment cycle is just going to be based on where valuations are at, what is happening with supply over periods of time, and whether that supply will come online, which is pretty easily measurable. So when I unpack this, what I see is the Brisbane story is apartments had a glut in supply from 2014, 2013 maybe, all the way to 2022.
Which on the back of a building boom, like there was cranes everywhere.
Cranes everywhere. Absolute cranes everywhere. And then there were a couple stories of instos, large institutions just buying up buildings, essentially being like, I just want one betters everywhere, wherever I can find them. Just get me all of them. All they were doing is studying the apartment supply market. They just had some analysts behind the scene being like, apartment supply, no one's building anymore because there's a glut. I'm just going to be buying this, pre-position myself, and then, now apartment prices have doubled inside 5 years. That's the Brisbane apartments story. It is a huge lesson for every property investor to pay attention to. It's one of the best case studies to look at. I've got 3 or 4 in my mind. The Hobart story in 2018. I've got a Newcastle story in my mind as to, some of the longer term fundamentals there. The Townsville story of right now, the Darwin story of last year to where it is right now, the Brisbane apartment story. All of these really shape lessons in my mind as to let's study market cycles because history repeats itself. And if you follow the clues as to what these cycles are telling you, you get a lot of insight as to where to look next.
Yeah, and I think those insights on market cycles are really useful because it's the days of just being a 30-year buy and hold investor where you're, buying a piece of land somewhere. That's not it's not the only way to do it. And I would argue it's probably not the most effective way to manage your asset base over that kind of time period anyway. It might be the easiest, maybe the lowest risk. But if you're an active investor, there are better ways to change in and out of asset classes. And just because something's a unit or a townhouse or whatever it may be, it doesn't really matter if you know, or if you got a good feel for what the timeline is on a cycle, and you can double your money in Brisbane units in 5 years and sell out and move on to the next thing. It's like super, super valuable.
Beautiful. Higher yield as well, lower tenancy risk. All of it's lower risk. People just want to live there. There's a large group of people that want it nice, simple as well. Like you won't have repairs or anything like that because it's embedded in the strata cost, and the yield is higher. So it's a nice, simpler investment. This probably sparks my interest a little bit when I'm looking at this. Is every morning I drop off my kids to school, and one of the en route in the eastern suburbs now is there's a whole building for sale. I don't know what's going on, but like there's an apartment building there. And 17 of the units in that building are for sale.
Yep.
I've looked into this for DA purposes before. There's 30 of them, but 17 are for sale at exactly the same time from one buyer in a distressed situation.
Okay.
So it's 17 really small apartments. They're only a 600 square meter block, and they've got 30 apartments on them. So a beautiful development that I look at being like, hey, that's the sort of land I want to buy. But now 17 apartments are for sale at the same time. It's already fully built. It was probably built 10, 15 years ago.
Distressed seller. You might
seller.
get it at quite a little haircut.
Yeah, it could be.
You're not at all.
Who's funding
like, you're not buying all 30, which is what
it's an insto.
You get an uplift there. But yeah, if you only get 17 of the 30, then yeah.
Yeah, it's an insto funding it for sure. It's a new building. You're buying it for yield, and you're buying it for the same play. It's the same movement that Brisbane institutions were looking at. Institutions were looking at in the Brisbane market. Super funds and things like that were picking up Brisbane assets at the time. The reason why I share this is I think if I'm buying right now, I'm not because I'm still lazy. I'll tell everyone when I am still too lazy to do it. We've talked about it recently, actually. But if I'm buying right now, I'm probably looking at an asset like that. I'm probably targeting the Melbourne apartment market because it's the same story. It's oversupply for a long period of time. Now we're in that period, the lull period, where there's clearly no oversupply into the future. There's clearly no supply into the future. An undersupply situation will be building up. And what I know is the government can't do anything about it. They could be like, let's draw here, go up, go please build. It's not going to work. The feasibilities aren't going to stack up. And the only way it does stack up, just like it's going to stack up in Brisbane now, is apartment prices will rise materially. And right now, in many parts of Melbourne, in nice parts of Melbourne, you can buy apartments below the build cost. Nice enough apartments. It's stupid. It makes absolutely no sense. I would happily take that trade, and you get a 7% yield in Melbourne for it. It's like, what? It's not a commercial asset with risky tenants there that could be in a regional market. That's kind of what you get. You have to buy a regional petrol station to get 7% out in like literally, Moe or some random suburb, Ararat, that has 10,000 people, suburbs we've talked about here. Or you can buy one in freaking Footscray or Preston's or, St Kilda, areas that, yes, have typically had oversupply and been horrible performers. But hey, it's 2025. What was horrible for the last 10 years isn't horrible right now. That's the situation that I see there.
Yeah, and I think particularly for apartment supply, it's a little bit easier because it moves slowly and it takes a lot of time. It's a little bit easy to predict as well. So you've got government planning, rezonings, things like that happen. But then you've also just got the interest rate environment, right? And we've gone from a period of very low interest rates where feasibilities were easier to make work, and the limitations were more on what can you build, maybe global capital markets as well, like out of COVID. But now we're in a situation where interest rates are really, really high. It's hard for feasibilities to stack up. And if people aren't putting in DAs, that's like by the time that corrects itself, there's actually there's actually spades in the ground. You're looking at like, okay, when you flick the switch, it's still like 3, 4, 5 years before the supply comes online. So like these apartment cycles have a long time lag, which gives you the window for prices to move.
100%, yeah. Very predictable too. You can unpack it. Maybe I find it a bit easier to predict now because I'm a developer. Like I've developed plenty of homes in my life. I can do the numbers. I can assess it. I can look at land sites. I can even do it for like 100 apartment sites and probably have the ability to get close enough to assess it and be like, okay, like, yes, they will stack up if you do 100 because they're really, really tall. But you have to sell them at the right price. You can't be selling a 1-bedroom apartment in Melbourne that's new for 350,000.
Yeah.
Just doesn't work. The cost per square meter of building is 8,000-9,000 now as at a minimum, and the cost of, like, if you just do the math, a 50 square meter apartment at 8,000, it's $400,000 just to build it. So it doesn't stack up. And Melbourne, you got to pay them. You got to pay Australia rates. Like, it costs a lot.
No, you need a margin as well. Like, developers aren't walking out and doing this for free.
Yep. It's probably baked into the $8,000 to $9,000 cost.
Yeah.
I've included the margin in there. But yeah, like really, really roughly, the numbers don't stack up. And when the numbers don't stack up, no one's going to do it, which means you know what your target market is. It's like, what? No one's going to build these things. Everyone's only going to build luxury stuff.
Yeah.
Our government in New South Wales, literally, they've got reports being like, let's use trickle-down housing. Fudge, we can't fix this. So in the meantime, let's just build $2 million apartments. And, in my town planner, architect planning meets and, just best way to describe it is hanging out with developers. They all look at two opportunities right now in Sydney. It's build for the rich, the really rich, like target the people who want to, buy $2 million plus apartments, or build for build to rent type schemes.
Yeah.
They're the two plays that actually make sense in the developer land at the moment. Everyone else, talking about duplexes and townhouses and things like that. Yes, they're attractive. They could be good if you want to make a little bit of money. But in the developer land situation, those are the two opportunities everyone's looking at right now.
Yeah, I think we're on a bit of a tangent now, but I think that might have been some of the thinking the government had when they're talking about like Woollahra Station and things like that. It's like, yes, okay, if we rezone that, you can put apartments there where the feasibilities are going to stack up because of the area it's in and what they're going to sell for.
100%. If you go through my search history, it's a dangerous topic, but my search history has a lot on Woollahra Station right now and what is happening around it, the streets around it, freaking every single property around it, the land sizes. Yeah, I've spent a lot of time studying that. Yeah, I'm a giant nerd, clearly. Okay, let's circle it back to the rental market as well. What's happening in the rental market across Australia too? Because this is really strong too.
Yeah, so this is another thing that in tandem for investors is, not to cut to the summary of this, but like a little bit of a nice opportunity where you can have increasing rental yields and capital growth kind of at the same time. But national vacancy rate has hit its like all-time record low number, like 1.4%.
Has it?
Nationwide.
Whoa.
Units 1.1, houses 1.7. So both, I would say, kind of crazy low. But yeah, when you're talking like nationwide, obviously there's some outliers, but that's an incredibly low, like if you were, and again, I haven't done this, so I'm talking a little out of my backside, but I imagine if you ran like a proper regression analysis over like 80 years or however long data goes, you might even pull this and be like, I think that's an outlier. I don't even know if that's like a legitimate data set. Like that's how low it is. Like 1.4%, like nationwide, like vacancy rates.
Cool. Let me humanize what Curtis just said with his super smart big words. So if you go through history and it's this big, there's this one time right now hanging out up here being like, what on earth is happening?
Hanging out down there.
Down there. Just hanging out somewhere out there where it's not with the rest of the pack. We are in that situation right now. We are not with the rest of the pack right now. I've talked about this a little bit when I'm talking about Brisbane house prices and being like, Brisbane's history, we're out here right now in terms of affordability. But when we look at the Australia story right now and you look at the rental market over a long period of time, we are in a situation where it's just like, what is going on here? That is what we'll be talking about. If we do this podcast in the year 2030 and we look at a chart being like, well, what happened in 2025? We'll go back to the 5-year episode 5 years ago and take a look. But that's what it looks like right now. Rental market is exceptionally tight, which is putting up upward pressure on rents, which really helps capital growth rates as well because rents go up, the income underlying an asset goes up.
Yep.
So the value of that asset should rise as well. Lot supporting it, especially in a lowering rate environment that we're in too.
Yeah, exactly. So like rents reaccelerating up 0.5 in September alone, 1.4 for the quarter. So yeah. And again, that's nationwide. That's not broken down, but pretty quick pace of increase as well.
For sure. Can I post something absolutely crazy to you? Like I'm talking this out loud and it's just so positive. Everything's so positive. Everywhere's rising. Rents are rising. Capital growth rates are higher. Property investors are making hand over fist at the moment. There's the richest per capita of Australia is going to be happening right now. Unemployment is still very low. Interest rates are stable. It's just so positive right now. Everything that I say is just like tick in some way. Is it, oddly enough, where investing strategy, when it's so sunny, is it actually time to flip the script and instead of being like buy, which is what everyone else is going to be doing? And yeah, we run a podcast, we're property brokers, buyers agents, etc. So, that's what we would typically say in certain environments like this. But we're sharing the environment. Does the strategy in this environment actually point to might be time to sell?
Personal choice, like I think yes. It depends what you're selling into though. Like I don't think holding cash is particularly attractive.
What are you going to sell into then?
You need to find less attractive assets basically. So, or you need to move up the value chain of like, I'm not doing a buy and hold. I'm doing something where I can add a granny flat, do a small development, something like that. But
no, think lazy. What about the lazy investor that's got, hey, if they sell, they release $500,000 and they're just like, I've already paid off my PPI. Let's just assume that's the case. Be like, what am I going to do in this circumstance where I can put my money in Perth, Darwin, and be like, hey, I'm going to make a fortune if I go and do it. And the market's racing in front of me because it's really sunny right now. What am I going to do if I did do that? So any random thoughts there?
Random thoughts? No, if you're not going to put it into something else that's useful, then I'd say you're better off holding. Like but if you can reallocate it to something else, like you might have a bunch of capital growth assets that have gone up by, if you held assets in Brisbane or Perth and you've, held them for 10 years, they might be probably worth a fortune now. You can sell out of those. You might choose to try and buy a block of units or something and get yield, or there's an opportunity to reallocate your assets.
Yep.
But
for sure,
I don't know that just liquidating and holding cash achieves that much.
Yeah.
Unless you think there's a downturn, but
No.
the outlook is a little too sunny to hold cash.
Yeah, exactly. And yeah, the whole concept of just waiting for the storm to come in and buy cash liquidate and hold on to cash right at the exact time and then buy in the middle of the storm. Like, that's too advanced for the majority of people. That's incredibly unlikely that anyone's going to be able to execute that perfectly.
Yeah, but it's more like if you were, so say you had some investments, you're like, I'm going to use the capital growth on these to buy a PPR or something like that. Like, I think it's a good window to, if you had reallocation plans as part of your journey, to be like, hey, this might not be a bad window to pull the trigger on some of that stuff.
100%.
It's a good time to switch asset classes.
But
so. If you're just like, I've got my PPR paid off and I hold a house in Brisbane for funsies, like, do I want to sell my house in Brisbane and put it in my bank account, or do I want to keep holding a house in Brisbane? Then
for funsies. Let's hold on to it for funsies.
Just keep holding it. Like, I don't know what selling it's going to achieve.
Yeah, I agree, actually. The reason why I framed that question, I think you actually answered it, where it's just like, if I'm thinking of a PPR upgrade strategy, if I'm at that point in life where I'm going to try and buy my PPR, if I'm a Sydney sider, I'd probably be like, probably want to do that around now.
Yeah,
because
I think
prices,
it's a good window.
Yeah, the prices are probably going to be a bit higher. And if I'm holding on to investments elsewhere, and they've delivered. If they haven't delivered anything, then definitely don't hold on to them. But it's a reallocation purpose where it's like an opportunity to debt recycle and things like that. There's opportunities to do that, in multiple markets if you entered them in the last 5-10 years, given where the price point is at and the sunniness that is there right now, you'll get a really good result and sell in very, very good conditions as well.
Yeah.
Awesome. Let's wrap it up. There is the final quarter of 2024 market wrap. We went through Brisbane, we went through Darwin, we went through opportunities, a chance to buy Melbourne apartments, went through selling down investment strategies. We went through all of it in this episode. And in the next one, we're going to go through the economic foundations that are supporting the current environment and go through line by line, topic by topic, exactly what is driving these conditions right now.